Hey everyone, welcome back to Corporate Decoder, the place where we take those giant corporate filings and turn them into something you can actually understand. Today we are diving into Tempus AI's latest quarterly report. Think of it as a sneak peek into the future of AI-powered medicine, and whether it's actually paying off. This report tells a story of big spending, acquisitions, and a bold vision for transforming healthcare with artificial intelligence. Can they turn that promise into profit? Stick around because we're about to decode these numbers and see what's really going on at Tempus. By the way, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. Come join us. Alright, let's dive into Tempus AI's report for the quarter that ended in March of 2025. First, let's check out their balance sheet. Their cash and cash equivalents are down quite a bit, from about $341 million at the end of last year to $151 million now. Their accounts receivable, money owed to them, went up big time, going from $154 million to $262 million. That means people owe them a lot more money. And they didn't make more money from it. Their goodwill, the amount they paid over the value of assets when buying another company, also went up massively, from $73 million to $325, and Ming putting another the value of assets when buying another company also went up massively. From $73 million to 320 other company, also went up massively. From $73 million to $354 million to $34 million to $325 million. On the other side, their liabilities also increased quite a bit. They have an increase in what they owe. It appears to be an expensive quarter, but they are investing into their company. So let's see if that means good news overall. Now let's look at the condensed consolidated statements of operations. Their net revenue, meaning the income they made after all expenses, increased. For genomics, they made about $193 million last year. In data and services, they made about $61 million compared to $43 million last year. In data and services, they made about $61 million compared to $43 million last year. That gives them total net revenue of $255 million last year. In data and services, they made about $61 million last year. That gives them total net revenue of $255 million first year. In data and services, they made about $61 million last year. But their costs also went up. That's not great news. Their selling, general, and administrative expenses, which include salaries and other day-to-day operating expenses, also went up, from about $79 million to $154 million. Overall, their net loss is about the same as last year. But now let's see their cash flow. For the 3 months ended March, their net cash used in operating activities was about $105 million. They purchased a lot of marketable equity securities, leading to a net cash used in investing activities. With all this said and done, they had a net decrease in cash, cash equivalents, and restricted cash. No convertible redeemable preferred stock at March 31, 2025 and December 31, 2024. As for acquisitions, they had a business combination net of cash acquired where they spent about $380 million. That's a lot. A big part of their assets are in goodwill and intangible assets. I wonder if that's really a good idea since they already spend a lot of cash. For most of their assets, they have a life of 7 years, while some, like software, only have a life of 3 years. This means that they only have 3 years to get their investment to pay off, which is a big issue if it doesn't happen. The net decrease in cash equivalents, and restricted cash was about $188 million. You definitely see them spending big with the effect of the acquisition. However, they might need to slow down if they bleed through money too fast. Now, looking at the statement of cash flows, there was no change in fair value of warrant liability, and they are increasing the amount of PIK interest, which could be a cause of concern since it means they couldn't pay those with cash. Also, the dividend liability is zero right now, which means they are not giving money to investors for holding the company, which means people probably won't buy their stock and existing holders won't want to hold on to it. There weren't as many customers as the previous year either, at least that made up a significant part of the accounts receivable. They acquired a lot of different organizations. What do? Well, Ambry is a leader in hereditary cancer screening. Deep6 AI is AI-powered software that can match patients to clinical trials. S-Engine Precision Medicine manages and executes clinical trials. All these services seem very useful to the company as a whole. There weren't legal proceedings happening, which is always good. Their accounting is correct, so it should be good. Looking at the purchases, they mostly focus on property and equipment. Additionally, their commercialization and reference laboratory agreement comes with a good amount of revenue. In the 3 months that were investigated in this report, the company had used a net $105 million in operating activities and $375 million in investities. That is an insane amount. Their main worry right now should be to slow down on spending the cash, since if a bear market hits and they run out, that could spell disaster. Nothing to report on defaults. Their interest income increased. They amended their convertible promissory note with Google. Overall, they seem to be doing decent. Their number of stock is increasing, however. It seems like they will be in hot water in a couple of years. The overall cash burn should be a cause of concern. Now, the report is pretty clear about these numbers. This company is definitely all in on AI in healthcare. The acquisitions show they're serious about building a comprehensive platform. The increased revenue is encouraging, especially the genomics, which is great, but the big spending increase should be a worry to anyone holding their shares. There's a big question mark on if the benefits of all these activities will outweigh costs, and if this whole direction will ultimately pay off, or will the company simply die off? I'd rather the company simply die off. Looking forward, keep an eye on how well those AI algorithms actually translate into better diagnostics and improved patient outcomes. These guys either need to slow down with the spending or make a lot more money. In addition, it will need to be seen if their long-term debt are going to hurt them significantly. Alright, that's our breakdown of Tempus's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Also, be sure to check out our Discord in the description. Thanks for watching. See you next time.